All right, good afternoon and welcome everyone to today's headline roundup. It's the last Monday in July and we have got a lot to cover. So if you have questions during today's presentation, type them into the question box. I'll try to keep track of that and pass it on to Dennis. But without further ado, Dennis, you ready to roll?
I am, and I've got a longer bit of content today than normal, so I'm going to move rather quickly, but have some updates on metals prices manipulation, the trial in Chicago relating to the JP Morgan Chase executives accused of manipulating the metals markets over 10 years is progressing. Some very interesting things came out of there last week. Also, I'm going to say it, I told you so. The recession is here. Modern monetary theory, or MMT as it is currently abbreviated, is really not modern, and it's really not theory. I told you it couldn't work, and now it has been proven not to work. So that said, let me just jump in here. The PMI index crashes into contraction in July. This is from Zero Hedge on Friday, July 22. While U.S. macro data continues to weaken, and on the heels of the Eurozone's unexpected plunge into contraction, analysts still expected flash U.S. composite PMIs to increase modestly. However, they were wrong. U.S. manufacturing slipped. U.S. services also slipped. And they slipped not a little bit, they slipped a lot. Now, if you're not familiar with PMI, PMI is an abbreviation that stands for Purchasing Managers Index. PMI surveys exist in 40 different countries and also in the Eurozone. And basically, it monitors business activity. So in the services sector and the goods sector, PMI has declined significantly. And it tells us really that recession is here. The blue line on the chart represents services PMI. The green line on the chart represents manufacturing PMI. And you can see that really since about a year ago in the middle part of 2021, you've seen the services PMI decline from 70 to now right around 47. And you've seen the manufacturing PMI decline from a high of about 64 or 65 down to about 52. So about a 20% decline on manufacturing, decline on services, which is really telling, better than 30%. So big declines in business activity. The article continues that the U.S. Composite Index also plunged into contraction, now at a 26-month low, which talks about the fact that we now have a technical recession that is imminent. I didn't have time nor space to add this to the presentation, but Janet Yellen, the Treasury Secretary, just came out and said, yes, I believe we may see a recession, and I was wrong about inflation. At least some of us were right. Commenting on the PMI data, Chris Williamson, who is the chief business economist at S&P Global Market Intelligence, said this: the preliminary PMI data for July point to a worrying deterioration in the economy. Excluding pandemic lockdown months, output is falling at a rate not seen since 2009 amid the global financial crisis. Yes, we're back to where we were at that time. Manufacturing has stalled, and the service sector's rebound from the pandemic has now gone into reverse. The tailwind of pent-up demand has been overcome by the rising cost of living. An increased rate of order book deterioration with backlogs of work dropping sharply in July reflects an excess of operating capacity relative to demand growth. That will not be good for the economy moving ahead. Supply constraints remain problematic. The weakening demand environment has helped to alleviate inflationary pressures. In other words, the best cure for high prices are high prices. Demand does drop. The market is now pricing in a rate cut. Where have you heard that? I said that the Fed would likely reverse course They would likely start to cut rates again at some point in the future. I've had a number of very bright radio guests that have disagreed with that, but I believe when you look at the two alternatives the Fed has, that's what we're going to see. The market is now just starting to price that in. So we'll have to wait and see how that plays out. But I believe we're going to see more easing that will likely lead to an even more intense stagflationary environment. Modern monetary theory. I said a couple years ago here on this podcast and on the radio program that it's not modern, it's not theory. John Law tried it in the early 1700s. Many of you longtime participants in the Headline Roundup webinar know the story. The outcome that was seen then is the same outcome that we're moving toward now. This article written by Lance Roberts says that modern monetary theory, the grand experiment, was tried following the pandemic-driven shutdown of the economy, and it has failed miserably. If you're a new listener, this is from Investopedia. It explains what MMT is. The central idea is that governments with a fiat currency system under their control can and should print as much money, should be as much currency as they need to spend, because they cannot go broke or be insolvent unless a political decision to do so is taken. Some say such spending would be fiscally irresponsible as the debt would balloon and inflation would skyrocket. I would be among those. But according to modern monetary theory, one, large government debt doesn't matter. It's not the precursor to a collapse that we believe it is. I would disagree. Modern monetary theory says, number two, countries like the United States can sustain much more significant deficits without worrying. There's no cause for concern. And three, a small deficit or surplus can be extremely harmful and cause a recession, since deficit spending is what builds people's savings. Now here, according to Mr. Roberts, is the critical paragraph. According to modern monetary theory, the only limit that the government has when it comes to spending is the availability of real resources like workers and construction supplies and so on. When government spending is too great with respect to the resources available, inflation can surge if decision makers are not careful. So even modern monetary theory says if government spending outpaces resources available, you will see a surge of inflation. T also says taxes create an ongoing demand for currency, and if there's too much inflation, you just raise taxes. So with that base understanding, Mr. Roberts says, let's review the tape. Let's see how this has worked out. At the end of 2019, federal debt outstanding was $23.2 trillion. 3 months later, in most states and many states, economies were shut down. That decision was the defining moment that implemented modern monetary theory with successive rounds of monetary stimulus, from direct checks to households or helicopter money to expanded government subsidies. As a result, by year end of 2021, just 2 years later, federal debt swelled to about 30 trillion. Government debt up more than 30% in 2 years. Now, if you take a look at debt versus economic growth, there's a chart here that does it by president. You can see now that we have now far exceeded any prior administration, going all the way back to Lyndon Johnson. When the massive flood of stimulus, when the massive flood of newly created currency temporarily made the economy seem prosperous, it at the same time created a lot of problems, which we are now seeing. The most obvious problem was the impact of dramatically increasing demand. With the economy shut down due to government mandated restrictions, and the government literally dropping money from helicopters, many people got checks in mailboxes, we have this huge boost of demand. Now, the basic economics of supply versus demand would dictate that prices would have to rise, and that's exactly what happened. But now we have the second problem. This is the lingering problem. Wages have not kept up with inflation. The chart shows in the red shaded areas when you actually have a negative change between wages and inflation. Black line on the chart represents the annual percentage change in real wages. And you see that wages are literally the same as they were now in 2020 when all the government stimulus started, yet prices are significantly higher. And that's why you're seeing credit card debt at record highs. That's where consumers are going to compensate for their loss in purchasing power because incomes have not kept up with inflation. Such is always the problem of injecting money into the economic system. The repeated argument that more stimulus helps the poor working class is erroneous. This author argued that Biden's stimulus will cut poverty for a year, then it will get worse, and that's exactly what has happened. Penn Wharton found that low and middle income households spent about 7% more in 2021 for the same products they bought in 2020 or 2019. That's an average of about $3,500 more. So the conclusion is when you provide free capital, a market-based economy will adjust prices to compensate for the additional demand for products and services. Those primarily living paycheck to paycheck will see their disposable incomes getting taxed away. If you take a look at this graph is very telling. This comes from Real Investment Advice. And this shows that the average American now has a record deficit requiring $6,350 in new debt annually just to maintain their standard of living. At the beginning of the year, it was $4,500. So this is how quickly inflation is literally destroying the purchasing power of lower income earners. The average American at the beginning of 2022 needed to borrow $4,500 annually just to make ends meet. Now they've got to borrow $6,350. That is a big, big increase, about a 40% increase in just about 7 months. Well, modern monetary theory policy proponents suggest that giving free money will boost economic equality. The reality is the opposite is actually the case. This shows the net worth of the top 10% versus the bottom 50% of the population. The bottom 50% of the population has 2.5% of the net worth, while the top 1% has 32.1%. The top 10% has about 70%. So you can see that the middle class is shrinking and the wealthy are getting wealthier. The allure, the reason the modern monetary theory is so attractive is that it promises literally something for nothing. Uneconomic green energy schemes, Medicare for all, free college, free housing, but there is nothing free. The Mises Institute, which looks at things from the Austrian economic perspective, which I would tend to look at things from that perspective as well, said this: the promise of something for nothing will never lose its luster. So modern monetary theory should be viewed as a form of political propaganda rather than any real economic or public policy. And like all propaganda, we must fight it with appeals to reality. Modern monetary theory, where deficits don't matter, is just an unreal place. And as you can see, the velocity of money has slowed significantly. Now I want to spend a fair amount of time here talking about what's going on in the JP Morgan related trial going on in Chicago. And I've got, as I said, a bit more than I normally have to cover here today, just because I wanted to get you completely up to speed on that. Mark, I see we've got a pretty good group here today. So before I jump into this last topic, am I missing any questions at this point, or should I continue?
There was only one comment so far, and it has to do with this topic. So it'll probably get answered as you go. And if it doesn't, we'll take it up at the end.
Okay, perfect. Thank you. And guys, again, if you have a question, just type it in the questions box, and Mark's keeping me on track, so I appreciate that. So this again, reprinted on Zero Hedge, written by Ronan Manley from Bullion Star. He said, with a group of former JP Morgan precious metals traders currently on criminal trial in front of a federal jury in Chicago, accused of engaging in a racketeering conspiracy involving precious metals price manipulation, commodities fraud, and trade spoofing, while another group of their colleagues have already pleaded guilty, now is a good time to ask how the bank JP Morgan is still considered fit and proper to not only continue to trade in the precious metals markets, but to continue to literally dominate the entire precious metals industry in London, Singapore, and New York, with the support of the London Bullion Market Association, the Singapore Bullion Market Association, and the operator of COMEX and NYMEX. So yes, JP Morgan Chase is still a big, big player in this market. Now, the article talks about some of the background here, and back in 2020, JP Morgan entered into a deferred prosecution deal, and under this agreement, they admitted wrongdoing for the criminal conduct of numerous JP Morgan traders and sales personnel on the bank's precious metals desk located in London, Singapore, and New York. The bank paid $920 million in the form of a criminal monetary penalty, criminal disgorgement, and victim compensation in relation to this criminal precious metal scheme. So that is the backdrop. Now, the current trial is really an extension of that investigation. This trial kicked off July 8, and on trial are Michael Nowak, former head of JP Morgan's precious metals trading desk, Greg Smith, a former JP Morgan precious metals trader, and Jeffrey Ruffo, a former JP Morgan precious metals salesman. They are accused of being involved in a criminal enterprise that entered and canceled thousands of fake precious metals futures orders, which are deceptive orders, for gold, silver, platinum, and palladium futures contracts between 2008 and 2016, with the purpose of manipulating precious metals prices. A fourth JP Morgan metals trader is also accused of similar crimes, and he will face a separate trial. Now, this trial featuring Nowak, Smith, and Ruffo is going on right now. Now, this was what was in the original indictment, and to be fair, this trial is still ongoing. So these are all allegations at this point. The defendants and others allegedly engaged in a massive multi-year scheme to manipulate the market for precious metals futures contracts and defraud market participants. In the current trial, the prosecutors are calling two former JP Morgan precious metals traders as witnesses. John Edmonds, who I mentioned on last week's webinar, and Christian Truntz. Edmonds and Truntz have already pleaded guilty for their roles in this scheme. And Edmonds, Flaum, and Truntz have all just testified in this trial. Now, you can go visit this article and read the testimony if you want. However, in their plea deals, Edmonds, Truntz, and Flaum said this, starting with Edmonds. He pled guilty to commodities fraud and a spoofing conspiracy in connection with his participation in fraudulent and deceptive trading activity. Edmonds said from 2009 through 2015, he conspired with other traders to manipulate precious metals markets. Edmonds also admitted that he learned this from more senior traders, and he personally used this strategy hundreds of times with the knowledge and consent of his supervisors. Pflaum, who was originally with Bear Stearns with Greg Smith, said this: between 2007 and 2016, he placed thousands of orders to manipulate the prices of metals. Bruns said this: between 2007 and 2016, he placed thousands of orders that he did not intend to execute for precious metals. The Department of Justice said that Truns admitted that he learned to spoof from more senior traders and spoofed with the knowledge and consent of his supervisors. And spoofing is putting in a trade that you do not intend to execute with the objective of manipulating the price of metals. So these guilty pleas by Edmunds, Pflaum, and Trounce happened in 2018 and 2019. And as a result of that, the Department of Justice moved forward with this case against Nowak, Smith, and Jordan. That indictment was filed in August of 2019. On November 14, there was another indictment which added Jeffrey Ruffo to the case. So then in 2020, the Department of Justice said, okay, JP Morgan has agreed to this deferred prosecution agreement. And I'm not a lawyer, but a deferred prosecution agreement says, yeah, we did some things wrong. We're not gonna let it happen again, and we're gonna pay this money. And prosecution is deferred against the company as long as the behavior stops. So in 2020, that's what happened. This deferred prosecution agreement was put in place. So at that time, William F. Sweeney of the FBI's New York field office said this: for nearly a decade, a number of JP Morgan traders and sales personnel openly disregarded U.S. laws that serve to protect against illegal activity in the marketplace. According to admissions and court documents, between 2008 and 2016, numerous traders and sales personnel on JP Morgan's precious metals desk located in New York, London, and Singapore engaged in a scheme to defraud in connection with a purchase and sale of metals that traded on futures contracts in the COMEX and the NYMEX. So in the deferred prosecution agreement, JP Morgan was defined as JP Morgan and its subsidiaries, JP Morgan Chase Bank and JP Morgan Securities. Now, that statement also referred to the next stage of the investigation, and that's where we are now. That's this trial that's occurring is a result of that next stage of the investigation. And keep in mind, it was that deferred prosecution agreement that had JP Morgan paying almost $1 billion in penalties. Now, Manley brings up a really important point. He said it's the elephant in the room. He said, given JP Morgan's precious metals desk located in New York, London, and Singapore was manipulating the price of metals for 8 years, then why are they still even allowed near the precious metals markets in London, Singapore, and New York? Let alone, why are they allowed to dominate these markets with the blessing of the organizations that administer these markets? Goes on to explain, despite its criminal activities in precious metals price manipulation, JP Morgan is still one of the most powerful members of the London Bullion Market Association and one of the most dominant banks active in the London gold and silver and platinum and palladium markets. Despite its crimes and manipulations, there are currently 3 JP Morgan entities that are members of the London Bullion Market Association. Not only that, but JP Morgan Chase Bank is one of the 7 full London Bullion Market Association market makers. It actually quotes gold and silver prices in all 3 LBMA products, spot price forwards and options. JP Morgan Chase Bank, the London branch, is also one of 16 direct participants in the daily London Bullion Market Association gold price auctions. These auctions set a gold price which is used daily in everything from exchange traded fund valuations to mine sales contracts to valuing billions of dollars of derivatives contracts like swaps and options. JP Morgan Chase Bank is also one of 13 direct participants in the LBMA silver price auctions that occur daily. JP Morgan is one of only 4 members of London Precious Metals Clearing Limited, a private company which runs the entire paper precious metals market clearing system in London. There are currently 2 active directors of the London Precious Metals Clearing Limited from JP Morgan, and they're named here. In fact, the London Precious Metals Clearing Limited's correspondence address is the same address as the London Bullion Market Association. In precious metals vaulting, JP Morgan is also one of the 3 bank custodians which operate a vault in the London Bullion Market Association market, in the London market. Brinks, Malka Amit, and Loomis also run LBMA vaults there. This previously secret JP Morgan vault is located under a JP Morgan building, and its location is given here. JP Morgan is also a market-making member of the London Platinum and Palladium market, and JP Morgan is also active on a number of LBMA committees. Since JP Morgan operates one of the largest LBMA precious metals vaults in London, there's also a JP Morgan rep on the LBMA Vault Managers Working Group. However, the members of this group are not publicized. LBMA also runs a few other working groups, one of which is the deliciously titled LBMA Financial Crime Working Group. Presumably, JP Morgan is not in this group, but there again, perhaps they actually run it and use the forum to share their practical experience with the rest of the members. A bit of a cynical, although maybe not completely unwarranted comment there. But the icing on the cake has to be that on the day when the U.S. Department of Justice unsealed its indictment against JP Morgan's global precious metals desk head, Michael Nowak, he was still a board member of the LBMA. You can't make this up. Then a few days after the September 16, 2019 announcement, the LBMA was no longer able to keep its head buried in the sand and was forced to remove Nowak from the board. So why is a bank whose precious metals traders manipulated prices for over 8 years, and in the words of the U.S. Department of Justice, defrauded customers through thousands of instances of unlawful trades that openly disregarded U.S. laws that serve to protect against illegal activity in the marketplace, why are they still allowed to be a member of the LBMA? That is a really, really good question. Everything that the precious metals traders did from 2008 to 2016, assuming this is proven, are a breach of the Financial Services Authority Handbook, and it goes on to list them. But the question is, why is the LBMA and LPPM not kick JP Morgan out of their associations? Why does the Bank of England observer on the LBMA board, Andrew Grice, not call for JP Morgan to be immediately ejected from LBMA? Perhaps it has something to do with the fact, through Morgan Guaranty Trust Company of New York, that JP Morgan was one of the 6 founding members of the LBMA in 1987. If you look at the 1987 Memorandum of Association of the London Bullion Market Association, you'll see it signed by Guy Field of JP Morgan. So the author, Manley, asks, is the LBMA merely a cartel front for JP Morgan and its fellow bullion banks to control the global precious metals markets, with JP Morgan pulling the strings? A lot of information there, but I believe, and the reason I bring this up is, one, to keep you informed. We have many times on this broadcast talked about the fact that we felt that precious metals markets were perhaps being manipulated. I think this just further proves that perhaps they have been, and perhaps they still are. Ultimately, though, I believe that the fundamentals will have to take over. I believe that the fundamentals of a fiat currency being devalued will be very bullish for gold and silver, despite what is going on presently with price. So that was a lot. I think that was about 15 more slides than I normally cover during this time frame, but I felt like I wanted to give you a clear picture of what was presently going on there. So that said, Mark, I have gotten through the material in just a couple minutes longer than it normally takes. So now we can take comments and take questions if there are some.
Okay. So I think you covered this, but I'll tell you, I'll give you Chris's comment here and see if you got more to say about it. His comment, first comment was with regard to the manipulation, is have these short-term manipulations had long-term price impact, or were they more, and maybe I'm reading this wrong, were they more short-term manipulations done over a long term?
I think probably, Chris, more the latter, more short-term price manipulations done over the long term. You know, defining long-term and defining short-term is a little bit tricky, and it's even tricky when you start doing analysis. But I would say, you know, short-term is weeks to months, and that's how I would characterize this. So the trade manipulations perhaps affected price over weeks and months, and they were done over a period of years, which is how I would define long-term. So hopefully that's clarifying.
Okay. And then another comment was any comment you might have on gold's odd behavior considering inflation and the bond market.
Well, you know, I think what I just covered might explain a bit as to why metals prices have not performed as one would expect in this environment. I think it'll be very interesting to see how this trial concludes. I think it'll be very interesting to see what the reaction of LBMA might be. I do believe that you're starting to see more physical delivery on COMEX. I believe that's going to change the dynamics of this. I believe that ultimately this is all going to be bullish for gold and silver, provided the easy money policies continue. And as I talked about early in this broadcast, I think that the chances of that happening are, in my opinion, greater than not. And now the market is starting to agree with that, pricing in a rate cut here for the first quarter of next year. So I think if all that happens, that's all going to be very bullish for this particular market. And I wouldn't vary from holding metals. Again, I wouldn't exceed 20% of your portfolio. But ultimately, I believe that this is going to be a good asset to own, given that we're headed definitely for a period of economic distress and likely stagflation, in my view.
I think that may have just answered Jeff's question, which was, you know, given the, you know, what does the crystal ball show for when these fundamentals begin to take over? His further comment being that we've been waiting for years now.
Well, yeah, I mean, I think depending, again, years is a term that, you know, how many years, but I mean, if you go back to calendar year 2000 and you look at, you know, where gold prices were, gold prices are still up roughly sevenfold from 2000. So that's a 700% increase in about 2 decades. So I think if you take a look at the long term, metals are behaving as you might expect, and the gold price has literally increased with the real inflation rate over time. I think that when you go back in time here a couple of years, where gold prices have now been consolidating, gold prices did run up significantly. So I think we're looking at a period of consolidation here. And I think technically speaking, there's a very strong cup and handle pattern for gold as well. But that pattern exists, again, for many years. And, you know, we could be in this handle pattern for, you know, arguably another several months to a year or maybe longer. So at the risk of sounding like the boy who cried wolf, I would be patient.
His one follow-up question then would be, are there signs or events that we should be watching for?
Well, I think there are some things happening now that indicate that this could be the outcome. One, there's certainly a lot more traders on the COMEX market standing for delivery of the metals, meaning that when the futures contract expires, they're taking delivery of the metals versus, selling the contract. So, I mean, I think you're already seeing some things like that. You're seeing central banks around the world, for example, like Russia and China, have increased their gold holdings. So I think you're seeing the fundamentals change presently. And I think that those who, and again, there's those of you on the webinar that disagree with this, but I think when you take a look at what cryptos have done recently, there are many that thought that would be the new gold, and I believe that what you're seeing now indicates that they may play a role, but I don't think they'll replace gold or silver. So, briefly, that's what I would have to say about that.
Okay, well, that was great questions and comments today. I don't see any more at this time.
Well, we will be back once again next week live. I will tell you that August 8th, we will be recorded. August 8th, we will be recorded. But August 1, we will be live. August 15, we will be live. So there's just a little preview of what things look like over the next few weeks. Thanks, everybody. Have a good week.
Okay, we'll wrap it up. Have a good week, everyone. We'll be back again next Monday, August 1st. Until then, have a great week. Take care.